Welcome to the Intermarket Analysis video update. This is a weekly video where I look at a number of different things that can impact the stock market in general and the S&P 500 in particular. This is being prepared for Monday, March 17th. The first area that I'll talk about is valuation, and there's been a lot more of that in the news as we're going down these days with the market, thinking that the market is overvalued. Well, people mention that when we're going up, but they really start to mention it when we're going down. It depends on how you look at this. Now, we look at it a different way when we look at historical information, and then we take that same approach, though, and then use it by looking forward. We look at earnings reports that have already come out and compare it with the price of the S&P, and then projections for what earnings should be going into the future. And that comes up with a ratio that we try to determine, is the market expensive, fairly priced, or actually inexpensive or cheap. Then I go through a pretty extensive look at growth versus value. And this has been a big area lately. If you watch any of the daily videos that I do, this has been what's really pressuring the market. When we're really going up and things are more positive, growth is outperforming value. When we're going down or the market is shifting into a different type of phase, that's when we see value start to outperform growth. And we're kind of right at that point where the last few weeks, value has been outperforming growth. And that's putting the market under pressure. Pretty much for all of 2025, the big growth stocks, the Magnificent Seven, Microsoft, Apple, Netflix, Google, they've been doing okay, but they haven't been exploding to the upside the way they had in 2023 and 2024. We're seeing them really slowing down right now, and that's putting some pressure on things. So we look at some growth versus value metrics just to see if we can get some insight there. Then I look very briefly at inflation. Now, there's a couple of different ways I look at this. There are some charts, mainly by looking at commodities. Now, there's reports that come out just this past week. We had CPI and PPI. Those are two big inflation reports, and that shows that inflation is under control. In fact, it's actually been declining. Well, we can also get some insight by looking at any of the commodities markets because they've been in uptrends lately, and that's causing some pressure on the markets. Then we do look at other markets. I look at all kinds of commodities markets just to get an idea there. We look at other indexes within the stock market, other sectors within the stock market. And then I go through more of an analysis of the 11 sectors that make up the S&P 500 and then look at them by themselves and then compare them with the S&P 500 to see if they're outperforming or underperforming the benchmark S&P 500. Then I look at some different indexes and just see how they're doing. And then I finish up near the end by looking at some correlations. How are stocks correlating to interest rates or to oil or to different maturities of interest rates? I look at some very long-term trends as well. And then at the very end, I take a list and I measure those things that are looking positive versus those things that are looking negative. Now, my definition of positive is when the 50-day moving average is above the 200-day moving average. That's considered an uptrend. And when we're in a downtrend, it's when the 50-period moving average is below the 200-day moving average. So, first we look at valuation. This looks historically back to 1980 at what were the earnings that have already come out and what was the price at the of the S&P at that time. And we can see we have what the price should be if it was a PE ratio of 10, 15, or 20. And then the black line, that's what the S&P is right now. You can see that we're well above the red dashed line. So we are considered to be expensive. We're well over that 20 level just by looking at it this way. The S&P would have to come down to about 4,000 just to get back down to that red dash line. And we're at about 5,500, 5,600 right now. So yeah, that would be quite a fall. Then down on the bottom, I show the spread between the current price and the PE ratio of 20 right here. That this also shows what the PE ratios were going back to 1980 and different events that have happened along the way and where valuations were at that time. Now, Robert Schiller comes up with a little different approach. He uses earnings over a 10-year period of time and averages them and comes up with a slight variation called the Schiller PE ratio. The current ratio is coming in at 35.21. As we've been going down, the ratio's been coming down, but it's still very high. When you look at it historically, it's a much higher reading than usual. The last time it came up to a really high reading, this was the dot-com boom and then the dot-com bust after that, 25 years ago. And we've been coming down a little bit lately as well. Now, I also put on here the mean and the median, and the mean is 17.22. The median is a little over 16. So we can say between 16 and 17, and we're still over double what the median and the mean has been through the course of this chart. So yeah, we're considered expensive by this ratio as well. Then if I hit the right button, this uses a little different approach using that same Schiller cape or the, it's the ratio that we just looked at. It also you also may hear it called PE10. Well, these are some standard deviation lines, and they move based on what's actually happening here. They're more dynamic, but we're above this +1 standard deviation. So that also means that we are expensive. This is a little different way. This is also more of a static standard deviation, either a +1 or -1. And even though we've been coming down lately, this is still showing that the market is expensive. And then we can compare it to other parts of the world. DM, those are developed markets, and that's the Cape across Europe, the US. We have emerging markets, and then just the US all by itself. You can see, even when you compare it to other different markets in the world, the US is still considered to be expensive. But the US feels that's justified because we have the best stock market, we have the best companies, we have the best economy. So we should be more expensive than the rest of the world. But there are times when it doesn't always work out that way. This is the great financial crisis here back in 2008 going into 2009. But the market looks forward. It uses forward PE ratios based on analyst projections and forecasts, and then compares it with the current price of the S&P. Now we're coming down as the S&P has been coming down, and all these stocks have been coming down. We had got up over 30 here with the mega cap 8. These are the like, of course, it's the Magnificent 7 plus 1 and it was up over 30. We still use that 10, 15, 20 scale. So yeah, they're considered to be very expensive. Now the S&P, that's the red line. It's coming down. It's still just a little bit above 20. So it's still expensive, but it was getting up close here into the 22 range, and that's very expensive. Then we have the mid caps and the small caps, the green line and the blue line. They're more fairly priced. They're actually a little bit under 15, but they've really struggled in 2025. And do they have the earnings behind them to justify their prices going up? For the most part, in 2025, the market has said no. And it hasn't been a real favorable environment for those smaller companies to actually see their stocks climb. Then we look at growth versus value. First, I look at growth by itself. Now, it's in an uptrend, but you can see how it's really been coming down lately. And this started about halfway through February. The market was becoming overvalued. There was concerns about the tariffs and problems with Canada and Mexico. And what about a ceasefire between Russia and Ukraine? There's things going on in Israel. The market was overvalued. We had a consumer sentiment report that came out that kind of sparked this whole thing. And we also had the consumer sentiment come out this past Friday, but this was a month ago in February. And that's kind of when we started to see things really go down. So even though growth's still in an uptrend, it's been coming down. It's below its 200-day moving average. And here's value. Not doing all that great, but it's in an uptrend all by itself. It's coming down to its 200-day moving average as well. Where if we go back to the value, excuse me, the growth chart, we're below the 200-day moving average. But where we get some insight is when we do ratios between the two, growth versus value on top. Still in an uptrend, but pulling back. And then on the bottom, it's value versus growth. These are straight ratios. And I do a lot of these inverted charts here because sometimes we might see something that we don't see by looking at it one way. We might pick something out by looking at it a different way. This is a growth versus value ETF where we've been really coming down, but bouncing back lately. And this is a value versus growth ETF. Value's been underperforming, but bouncing back up, but not enough to change the overall trend, at least yet. Here's another look at growth versus value, really falling back, but the trend is still up. And then value has been underperforming, but has been bouncing lately. But you can see we're starting to come back down. This is what we'll be watching. Is this going to continue to fall? Is growth going to continue to go up? That would help us to switch back over to things looking more positive. Like on this chart, growth is still in an uptrend compared to value, but it has pulled back. It's coming back to the 200-day moving average. If this could keep going up, that'll be more positive. If this starts to fall and we eventually get to the point where we see the blue line cross below the red line, that's going to turn things more negative. Now, when I show this in the daily video, a growth versus value ETF and do a ratio, we're falling below the rainbow. So we've been seeing some weakness here, but we could come back or we could continue to fall. And that's what we're going to be watching every day. This is that same thing, value versus growth, where it's been underperforming, but starting to outperform recently. Then we look at this just with the small caps. It's still in an uptrend, but you can see that small cap index has just been getting hammered, something fierce. And that has taken the ratio down below the 200-day moving average. And that same thing with the mid caps. The index is really falling. The ratio has been really falling under its 200-day moving average. Now, the one that we pay attention to is S&P. Now, it's in an upward trend here, but it's also taken a real big hit as the S&P has been coming down. If this can start to go back up, that might help the S&P to go back up. If this continues to fall, that's kind of likely that the S&P will continue to fall as well. Okay, then we look at inflation. This is a monthly chart of the CRB index. It is in an uptrend. But then what's interesting is there have been a lot of inflation concerns. But when we look at this monthly chart of inflation versus deflation, we're still in a downtrend and we haven't been moving all that much, at least yet. This is a daily chart of the CRB index, which is in an uptrend. That's a little bit inflationary. And then we watch this, the Baltic Dry Index. What does it cost to ship products from point A to point B in the Baltics? Well, it's been in a downtrend and it's still in a downtrend, but it has been bouncing back up lately. Then what are the inflation expectations? This is an ETF and this is a weekly chart and this has actually been coming down since the beginning of 2025. So as far as what this ETF is predicting, they see inflation actually going down. Then some other markets, we look at aluminum, which is in a downtrend. The blue line's below the red line. That's not inflationary. Corn is starting to go into an uptrend. That could be inflationary, but it has been falling back, but it's still above both the moving averages. Wheat is still in a downtrend and kind of chopping sideways lately. We look at fertilizer, and this is a long-term chart where it had been going up, but now it's coming down just a little bit, way over on the right-hand side. Lumber, I've started watching that again recently. It's in an uptrend. That could be inflationary. Oil is actually going down and we're below 70. We're into the mid 60s or so range right now. That's not inflationary. Then we look at a ratio between gold and oil. Well, gold has been going up, oil's been going down. So that's why this ratio is going up because gold is outperforming. And then we look at a correlation. We have the 10-year yield, which is in black, and that's been coming down for the most part lately. And then we look at oil, which has also been coming down, but there's not a real strong correlation. When we look at these correlation charts, the higher the reading, the stronger the correlation. That would be a +1 correlation. That means they're going in the same direction at the same time. If we get a really low reading, that's all the way to a -1 correlation, and that means they're going in opposite directions. If one's going up, the other one's going down, and vice versa. We look at gas, which is kind of chopping around here, but it's still in a downtrend. Look at diesel, which has also been dropping down lately. And this could be friendly for the market. We're seeing some of these things coming down lately. Heating oil's also been in a downtrend. Natural gas is in an uptrend, but it was just getting hammered. But it's gone up pretty big here in late 2024 into 2025. Copper, now this is what folks like to use as a barometer of the economy. And if the copper market's going down, that means that this market anyway is anticipating economic weakness. We're in an uptrend, and we're also in an uptrend on the weekly chart as well. So this bodes well for the economy going forward. You can see when we came up out of the COVID plunge here, all that stimulus, all the fiscal policy and everything was the copper market really took that as positive and it went up and then that started to produce some inflation and then it ended up coming back down. But it's actually in an uptrend right now. We look at a copper to gold ratio. Well, copper's been in an uptrend, gold's been doing well. So we're not seeing much of a change, but overall, copper's been underperforming gold. This is a longer term look at that same chart. That's the black line is the ratio. And then just to give you some context, there's the 2-year yield in green and the 10-year yield in red. Gold just set a new all-time high this past week. It's in an uptrend. Silver's not back to the all-time high yet, but it's also in an uptrend and doing well lately. We look at the closing price for gold on top, the closing price for silver, and we see down here that there's a pretty strong correlation. They're both going up or down generally at the same time and in the same direction. And we look at a gold to silver ratio on top. When this is going up, gold's outperforming. When this is going down, silver's outperforming. And then we plot that with the US dollar index, and we see that there's a pretty high correlation between the gold to silver ratio and the US dollar index. It had been around neutral for a while, but now it's starting to show a little more strength here. And this just shows us the interplay between precious metals and at least the dollar index, the US dollar. Then here's the dollar chart by itself. It's still in an uptrend, but the last week to week and a half, it's just been getting hammered. We were up into the 107 range, and now we're down into the 103 range. And here's the euro, which has been going up as the dollar's been going down. And then we plot the Japanese yen, which has been going up. The euro's been going up as the dollar recently has been going down. And then I break it out here, where the euro's still in a downtrend compared to the dollar, but it's really been bouncing back up, and the Japanese yen in a downtrend, but really been outperforming recently, about February. That seems to be about the point when everything really started to shift, about the middle of February. Valentine's Day, we can blame everything on that. And then the British pound is still in a downtrend compared to the dollar, but it's been bouncing back up as well. And we look at some index ratios. This is the weighted version of the S&P, which is the bar chart. And then the red line is the equal weight version. And when this is coming down, that means the equal weight is underperforming the rest of the market. But as we've been coming down a little bit, we're seeing the equal weight doing a little bit better from time to time than the weighted version of the S&P, even though these are on different scales. This takes a ratio of the equal weight versus the weighted version, and this has been going back up here a little bit, but it's been really choppy going into late 2024 into 2025. Then we look at stocks versus commodities, starting to see a downtrend with this ratio. Stocks have been outperforming for quite a while. Now they're starting to show more of a negative trend. This is that same chart, but an inverse of that. Commodities have been underperforming. Now they're starting to outperform. The NASDAQ 100, which has been under pressure, and the S&P 500, which has been under pressure. This just shows that the S&P is actually holding up a little bit better as the NASDAQ has been underperforming. And the S&P 100 is underperforming the rest of the S&P 500. And the S&P 100 are the biggest stocks that make up the S&P 500. And the NASDAQ, which had been doing really well, but it's been under pressure, as has the S&P. But the NASDAQ is starting to underperform the S&P. The NASDAQ 100 is actually holding up a little bit better than the NASDAQ itself. Now, it's not that the NASDAQ 100 is doing great. It's that the NASDAQ itself has been under more weakness, and that's why we're seeing this ratio going up. In fact, it was last summer when we started to see the NASDAQ outperforming the NASDAQ 100. That's why this ratio was going down. Now we could be starting to see a shift back. Now, if we could get the NASDAQ 100 to be in an uptrend and see this ratio going up, that would be more positive for the market. We look at the mega caps, the really big stocks, and compare it with the equal weight, really been underperforming lately. Small caps just doing really bad. And when you compare it to the S&P, it's doing even worse. And here's another look at the small cap to S&P ratio. That's the red line that continues to go down. The blue line is the S&P. This is the robotics and AI ETF. Not doing all that good these days here. When you look at it alone, it's holding up a little bit better, and that's just because the tech sector has been under so much pressure lately. So this has been chopping along sideways. And then another AI related ETF is actually coming down and testing its 200-day moving average, but it's still in an uptrend when we look at it by itself. You can see in 2023, this is when AI really started to be the rage. You can see the massive amount of volume that's picked up with this ETF. Mega caps coming down and actually falling under their 200-day moving average. The Dow Jones Composite Average, which takes the Dow, the transports, and the utilities together, all of them have been under pressure lately, but the Dow's still holding up about the best. And then we look at the advanced decline line. This is more negative, although on Friday it did show some improvement. We're below the moving average with all the indexes, but we're coming just about, excuse me, just about back up to the moving average here with the S&P 500. Then we look at traditional Dow theory, which looks at the Dow and the transports. Both have been under pressure, but you can see the transports have been underperforming. Utilities have been going more or less sideways, and that could be more of a defensive play. Now, there's some that make the case that, well, aren't utilities a growth area? We have AI, we have electric vehicles, we've got all this cryptocurrency mining, all this stuff needs electricity. So is that why utilities might be going up? Because we're seeing a real shift. Because it takes a lot of energy to do those things. Well, it could, you could make a case for that, but typically, historically, utilities have been more defensive. We look at the Dow and do a ratio with the transports, and the Dow's just outperforming. And it's not so much that the Dow's doing great, it's just the transports have been doing bad. And you can see it by here, this chart. This shows how the transports have been going down. Then we look at another ratio, the transports to the S&P. Even with the S&P going down, the transports are going down even more. All right, and then we look at the correlation between the S&P and the Dow transports. Still pretty strong here. Both have been going down together. Instead of using traditional Dow theory, we replaced the Dow with the S&P 500. This has been under pressure. And instead of using the transports, we use the NASDAQ. This has also been under pressure. Then we break that down a little further. We use the equal weight version of the S&P where it's held up a little better. It's gone down too, but we don't see this big downward line like we're seeing with the S&P 500. And we have the QQQ equal weight here instead of the NASDAQ. This has also been under pressure lately. This line is from this previous high here, and it might be a support level in here. Then the FANG index. This was interesting. In Friday's session, we were below the 200-day moving average. We came right back up. These are the really big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia, and some other ones. We came right back up to the 200-day moving average, and we're just a little bit above it after Friday's session, after falling below it. The Wilshire 5000 is still underneath its 200-day moving average. The total US stock ETF also still under its 200-day moving average. The low volatility ETF, this has been holding up a little bit better. It's been in an uptrend. And when we compare it to the S&P, it had been really underperforming. Then we bounced around a little bit over the summer. Now this is really starting to go up compared to the S&P. It'll be more positive if this ratio goes down. That means the S&P is outperforming. If this continues to go up, that's going to be more negative. ARK, which is a very popular ETF, back down under its 200-day moving average. And then we look at semiconductors, which are a huge part of the market. We're down underneath both the 50 and 200-day moving average. We stay down here, we're going to see a death cross here. And it was in early 2023 when we saw a golden cross, and that was the start of it. Actually started back in late 2022, right down here. But it takes a while for the trend to actually get established. And that has carried us up until the present time. Are we going to see a general shift in trend here? SOX index, this also is another way to look at semiconductors. It's already been in a downtrend and also showing some recent weakness here. And then the SMH ETF, it's the semiconductor ETF, also starting to see a death cross here. And then we look at this it's the same ETF, but I plot a rainbow on here and it's well under the rainbow. The rainbow's starting to get bunched up and now we're actually falling down a little bit. Then we do a ratio between the semiconductors and the tech sector, just kind of chopping around lately, not really showing much conviction. Then we look at all the stocks in the world, but take those out of the US. This is actually looking pretty good. But then when we put the US back into the equation, not looking so good anymore. So US stocks, since 2025 started, have really been underperforming the stocks in the rest of the world, according to this ETF. Energy, when we're in a more positive environment, it will continue to underperform the tech sector. Lately, it's starting to outperform enough to where we might see a golden cross here with this ratio. Growth, which has really been under pressure when compared to safer bonds, bonds are positive year to date. Stocks are not. And because we've been falling like this, that's why we're seeing the performance that we've been seeing. Then we look at the tech sector and compare it with the 10-year yield. We're actually starting into a downtrend here. That's more negative. This is an inverse of that, showing the 10-year treasury yield to the tech sector. Interest rates are now starting to outperform on a trending basis. We look at discretionary, which is more growth, staples, which is more defensive. Even though this is still in an uptrend, look at just a massive drop. And a lot of this has to do with Tesla. It's come down well under its 200-day moving average with this ratio. And this is an inverse, showing how staples have been really outperforming lately compared to discretionary. Gold, and it's not, well, gold has been doing quite well, but the S&P has been going down. That's why we're seeing this ratio skyrocket. And then gold beats the S&P 500 this century. Okay, the century is only less than 25 years old. All right, but I guess you want to say things this way. The white line here is gold, and the blue line is the S&P 500. Okay, and then we compare gold to the dollar. The dollar's been going down, gold's been going up, so that's why we're seeing this ratio going up. And now this is a little bit of a concern. This is another barometer of the economy. These are risky loans, very high leverage loans, and they've been doing quite well. Now, there's a couple of times here they fell under their 50-day moving average. That's also happening right now. So we want to keep an eye on this. We have not come down to the 200-day moving average since 2022. If that happens, yeah, then we're going to be a little bit more nervous about the economy. But we're seeing a little bit of weakness here where copper, the other barometer that we look at, it's in an uptrend right now. And for the last number of months, they've actually been contradicting each other. And the NYSE composite, it's holding up about the best right now, and even it's down to its 200-day moving average. All stocks, which looks at US and international stocks, and a lot of this strength that we're seeing are more international stocks. It's coming down to its 200-day moving average. Emerging markets are in an uptrend as well compared to the US. And then the Japanese Nikkei, it's actually been under pressure lately. It's been jumped a whole lot of mess right up here back to the 1989 high. And the micro caps in danger of possibly generating a death cross and under weakness. These are the smaller stocks. Bitcoin just is having a real difficult time. It's still in an uptrend, but it's dealing now with its 200-day moving average. It cannot seem to stay above 100,000. Then we look at the S&P and the home builders ETF, and not a real strong correlation right now. So we're not getting a lot of insight there. And then going back to the beginning of 2025, gold's doing the best, followed by the price of bonds. Third place is the dollar, but below this line, everything's negative. And then we have oil, which is the red line. And then stocks are actually coming up in last place right now. And then we look at internationally. This is the KST, another long-term momentum oscillator. We're starting to go down in China, but there was some news, speculation that maybe the Chinese government is going to do some things to try to stimulate the Chinese economy. And this big upward move that we saw here, that's kind of where that move came from. So maybe that'll help the Chinese market. Emerging markets, they're outperforming the US, but they're actually in more of a downtrend themselves. Europe is starting to roll over, even though it's been really outperforming the US. Japan is looking like it could be rolling over, and the US is already in a downtrend using this oscillator. Then we look at a long-term chart. This is a monthly chart of US stocks to world stocks. And you can see it's really coming down, but we're still above this moving average. But when we look at the percentage price oscillator, we're really dropping off. And that started right about at the beginning of 2025. So we're potentially seeing a real shift in the overall environment. Now we could turn around and get this back. But that's why we look at all this stuff. It's not just to waste time and to think, ooh, isn't that cool? We're actually seeing the potential changing of the overall stock market climate. Then we look at bonds, both based on price here. This is the 7 to 10 year bond ETF. And here's another look at price, or we're above the 200-day moving average, and that's positive there. We're seeing some weakness here. This is a long-term chart of stocks to bonds, monthly chart actually coming down to the blue line. That's the first time we've touched the blue line in quite a while, going back to late 2020. We're in a downtrend here when we look at world bonds, though. Even though they've been coming up, they're still in a downtrend overall. Sorry about my voice here. It's been a long day. And for the first time in quite a while as well, going back to 2022 when the market was under pressure, we're starting to see bonds possibly outperforming stocks. Now, this could turn and come back down, but if it continues to go up, that's going to be more negative for stocks. Then we look at junk bonds, which are under some pressure now, but they're still dealing with their 50-day moving average. We look at corporate bonds, which are actually starting to go into a downtrend now. They've been under some pressure lately. And we look at the spread between risky bonds like junk bonds and more conservative bonds like government bonds. It's holding up okay for right now, near the lower end of the rainbow. And we see there's a slight correlation between stocks and bonds right now. And as the S&P's been going down, bond prices have been going down, and interest rates are going back up. But then we saw a bit of a reversal there recently, and that has helped stocks stabilize at least a little bit. And with the corporate bonds, we're not quite sure what the trend is here. I guess both lines are still going up, but we started to see the blue line cross below the red line, but now it's not quite sure what it wants to do. And there's really not much here. This is a Fibonacci study of the 10-year yield, and we're in between all these blue lines. And we're seeing overall, since the COVID crash and we started to come back up, we have shifted to a higher range for interest rates. And same thing here with the 30-year yield. We're in between all these Fibonacci lines. So we're really not getting anything there. I just include them so we see them at least once a week. And then we look at a ratio between stocks and the 10-year yield. Stocks are starting to underperform now. Junk bonds holding up okay, but under their 50-day moving average. And then we look at a ratio where we look at junk bonds versus more conservative bonds. And junk bonds are actually underperforming a bit as we're seeing a little bit more favor recently into government bonds. Then we look at the daily chart here of the different maturities, going starting at the 3 month and going out to 30-year. We kind of watched the wave of all of this together, and interest rates had been coming down. Now they could be starting to go back up. And this is a weekly chart. I've been watching this red line and talking about it now for quite a while. This is what caused all the problems last summer when Japanese rates started to go up. Well, it's going up here, but apparently the world has enough problems to deal with right now anyway. And then we look at the volatility of bonds. That's the move index, and it's been going up but lately coming back. We look at the volatility of stocks. That's the VIX, which was really going up and now coming back down. And we see there's a pretty high correlation between these volatility measures. And then we look at bonds compared to stocks. When this is going down, that means bonds are underperforming. But look at what's happening recently here. It's really been coming up. And we look at the tech sector with bonds falling further beneath the rainbow. The S&P 500 is short-term bonds falling beneath the rainbow. The S&P 1500, another broad market measure with short-term bonds falling beneath the rainbow. You're going to hear that a lot here. The broad market with 3 to 7 year bonds beneath the rainbow. And then we look at the long-term price of the 30-year bond. It's still in a downtrend overall. And then when we do a ratio between the long-term bond and CRB index, we're seeing this rolling over. For the last few years, bond prices, even though they've been under pressure, they've been outperforming commodities, which have been doing even worse. That could be starting to change. And then just to keep an eye on this, we're watching the German 10-year yield. I brought this up a week ago because the German market had been doing quite well. But then if you look at their 10-year yield, it's just really been going up. There's all this speculation. Who's going to help Ukraine? Is it going to be the US? Is it going to be the EU? And the German market is the biggest part of the EU. And their market was going up, but their interest rates were also going up. And could that be because they might be the ones that actually end up helping Ukraine? Just speculation on that part. And then we look at the different sectors. We look at the material sector by itself, which is in a downtrend. Then we compare it with the S&P, and it's doing even worse, even though the S&P has been doing bad lately. Communication, this is a growth area, falling down below its 50-day moving average, but still holding up better than the S&P these days, even though it's been pulling back recently. Energy, which just cannot decide what kind of a trend it wants. It goes above, it drops below. It's all over the place right now, but it's still underperforming when we compare it to the S&P, although it's seen a recent surge. Financials, which have been a stronger part of the market, they're under their 50-day moving average. But even when we compare it to the S&P, the financials are holding up better. Industrials falling down and dealing with their 200-day moving average and just kind of chopping sideways in a downtrend here when compared to the S&P. The tech sector, this is the real growth area, falling down well under its 200-day moving average and in a downtrend when compared to the S&P. And this ratio is not looking really good right now. The staples sector, which is more defensive, coming down and dealing with its 200-day moving average. And it's in a downtrend compared to the S&P, but it's really been going up lately. About halfway through February, it seemed to catch fire. And real estate, which can't seem to decide if it wants to be above or below its 50-day moving average and 200-day moving average, it's been underperforming, but lately, as interest rates have been coming down, this has been going back up. Utilities, again, it could be considered a defensive area or a growth area, depending on your perspective. We're still coming down and just bouncing off the 200-day moving average. And it is outperforming a bit recently, even though it's in a downtrend. It's probably going to switch to an uptrend here pretty soon. And then we look at the S&P to utilities ratio. This has been so choppy recently. I used to show this all the time. When we're going down, when we're going up, it's not really showing an awful lot of conviction. And this could suggest that maybe the whole market climate is starting to change and become more defensive. And we look at healthcare, which is defensive. It's in a downtrend, but it's dealing with its 50-day moving average. And it's still underperforming the S&P until recently. That's when we started to see the shift. Discretionary, which had been doing really well, now is not doing so good. And it's still in an uptrend, but really falling down below its 200-day moving average with the ratio. Then I look at correlations, stocks to the dollar. Pretty strong correlated relationship. They're tending to go in the same direction at the same time, which lately has been down. Stocks have been going down, the dollar's been going down. The S&P 500 to oil, generally in the same direction. Stocks have been going down, oil's been going down. Then the S&P to interest rates, a slight tendency to go in opposite directions. And the tech sector to the 10-year yield, that's neutral right now. When we're in between this 0.25 and minus 0.25, that I consider that neutral. And then we compare stocks with the short-term yield, the 2-year. It had been stronger, but now we're starting to see this work down into a neutral relationship. And some long-term looks here. This is a monthly chart of the NYSE in an uptrend, but coming back down to the moving average. Now, this is the Copic curve. This is another momentum oscillator, it's starting to roll over. Even though the NYSE's been holding up, it's seeing some weakness here. And we've been watching this now for a while. Then you look at a daily chart where for 2023 and 2024, the NYSE was doing great. Now it's starting to pull back. And we look at a monthly chart of the S&P, we're also seeing some weakness here with the momentum longer term. Again, this is a monthly chart, not just a daily chart. And we look at the S&P on top and we look at a ratio between stocks and commodities. We saw that earlier on another chart. This is longer term and this is starting to roll over as well. And then we look at the S&P to global stocks coming down as global stocks have been holding up better. We had been outperforming here with the KST, this long-term oscillator, but now it's starting to show some weakness. Then here are all the things that are positive here. The growth and value indexes by themselves, copper, the US dollar, the CRB index, gold, silver, and the mega caps. Even though a lot of these have been under pressure, they're still in uptrends. The FANG index, ARC, the low volatility ETF staples, the Dow Jones Composite Average, bonds based on price, except for the world bonds, the tech sector, high leverage loans, the Dow, the NYSE, and Wilshire, the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. Now, some of these we could be getting ready for a death cross with the small caps and the micro caps, and even the mid caps. If the longer they stay underneath those moving averages, the more we might see that. All stocks are still in an uptrend. Emerging markets, that's one of the better looking areas right now. And Bitcoin is in an uptrend, but it's really having trouble lately as well. And then on the negative side, we have the euro, the yen, the British pound. Even though they've been really bouncing up against the dollar, they're still in downtrends. And then looking at the semiconductors. Now, I should have changed this. The ETF is not positive. We've just seen a recent death cross with that. And world bonds based on price are in a downtrend as well, and corporate bonds. It can't decide what it wants to do right now. So thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.